Good afternoon, everybody. My name is Larissa Pitula, and today we'll have a wonderful speaker and our guest, Julia Flenters. Did I say it right?
Yeah.
Okay, from Vanguard. And Julia will talk about health savings accounts, tax saving strategies utilizing this powerful tool, and what we can make the best out of this type of accounts. We are planning on running about 30 minutes presentation. We'll leave about maybe 10 to 15 minutes for Q&A, so please stand by. And without further ado, I would like to introduce Julia and let her take over from now.
Perfect. Thank you so much. And thanks all for joining us to discuss health savings account and how this unique investment vehicle can be a really powerful tool for wealth building and funding your healthcare costs now or in retirement. So this is our agenda for today. We are going to discuss common misconceptions around health savings accounts, followed by debunking each of these misconceptions. I'm going to provide you with an understanding of HSA basics, the unique benefits of HSAs relative to other investment vehicles, and how you can consider using an HSA as part of your long-term financial plan. So first, we're going to talk about what is an HSA. So in 2022, HSAs hit $100 billion in assets. There's more than 333 million accounts opened. So HSAs are becoming more of an opportunity. They're growing at a healthy pace. When we look back to 2006, there was only 1.7 billion in HSA assets. So this is something that every person should be familiar with because they're growing so much. We're going to discuss exactly what an HSA is and who will be able to take advantage of this investment vehicle that can help protect against rising medical costs. So for HSAs, so new legislation, it was passed back in 2003, which allowed the creation of the first health savings account that was on January 1st of 2004. In order for you to be eligible to open and contribute to an HSA, you must be covered under an HSA qualified high deductible health plan. And what this means is that these health plans in 2023, they have to have a deductible of at least $1,500 for an individual or $3,000 for a family. A high deductible health plan, they charge lower premiums than these traditional insurance plans, but they come with higher deductibles and higher out-of-pocket maximums, which you can see in this first chart. About 53% of American private sector workers today are currently enrolled in a high deductible health plan. That's as of 2020. That's up from 39% back in 2015. That number is continuing to grow. But because of this requirement that you must have a high deductible health plan, some people won't qualify to contribute to an HSA if your health insurance is not high deductible. Also, individuals who enroll in any parts of Medicare, including Medicare Part A, you will not be allowed to contribute to an HSA after Medicare enrollment. And last, you can't be claimed as a dependent on someone else's tax return to contribute to your own health savings account. So looking at the 2023 numbers, you are allowed to contribute $3,850 or $7,750 per family. There's also an extra $1,000 catch-up contribution per eligible participant if they are 55 years or older. So let's say one spouse has coverage for the entire family under a high deductible health plan, and the other spouse has their own self-only policy, and that is not an HSA qualified plan. Spouse one can still make that full family contribution to the HSA if they personally don't have any other disqualifying medical coverage. So you have up until the tax filing deadline each year to make your HSA contribution for the prior year. So you want to make sure you know the annual contribution limits from year to year. They can and they do change. But the main feature that makes this investment vehicle intriguing is that HSAs provide those triple tax benefits: pre-tax contributions, tax-free growth on the investment, and tax-free distributions when you use the funds for qualified medical expenses. And we're going to speak more about these tax benefits a little bit later on in this presentation. So to set the stage for our discussion today, here's the top misconceptions around HSAs that exist today. So 38% of investors who have an HSA believe that if they don't spend the funds in the current calendar year, they're going to lose the money. And 54% of HSA owners don't realize that they can invest their HSA dollars outside of cash. And 33% of HSA owners don't know anything about the tax benefits. Many people know that there is a tax benefit, but they haven't been educated, don't entirely understand what the major tax advantages are. And last, 46% of HSA owners don't know that they can take money out of their HSA for non-medical expenses after age 65. So one thing we can all agree on, we're going to have healthcare costs in retirement. And according to the Employee Benefit Research Institute, a married couple is looking at $270,000 on average to pay for medical needs in retirement. And an HSA could be a really great way to fund this expense. So more and more employers are starting to offer high deductible health plans because employers are saving money via the lower premium costs. So in a conventional plan, you can see that the premium is higher than the high deductible plan, but the out-of-pocket costs are higher for the high deductible plan. So employers can pay a lower premium towards their employee coverage, as well as contribute an amount into their employees' HSA. So many healthy employees, they end up spending a lot less using a high deductible health plan, and then they can save their HSA money for the future. Also, in addition to the actual lower cost savings for this high deductible health plan, by offering HSAs, it also benefits the employers by reducing their tax burden. So employer contributions that they make to an employee's HSA, they are tax deductible. So when you take these extra tax benefits into account, this type of health plan is set up to be widely cost effective for employers. I feel confident in saying we're going to see these grow in popularity in the years to come. Because if you think about it, your employer, they're paying a huge portion of the cost of your premiums to cover your medical expenses. You don't benefit financially if you're a relatively healthy person because you don't get any kind of refund of the unused premium payments. So this serves as a big incentive for health and wellness. So the HSA can be used for qualified medical expenses, and employees keep what they don't spend. So most people contribute to their HSA directly from their paycheck in coordination with an HSA vendor that's selected by their employer. This gives you the max benefit of not only avoiding the federal income tax on your contributions, but also you don't have to pay the FICA payroll taxes. So for the few who don't have access via your employer, you can open up an HSA directly with any of the HSA providers that are out there. So as the employee, you need to decide whether you want to pay higher upfront costs when you go to the doctor and then save for unexpected costs, or do you prefer higher premium costs with less upfront out-of-pocket exposure? When you do the math, many times it points to the best match being that lower premium with that ability to set aside money for unexpected costs that may or may not occur. And then if you or your employer changes to a health plan where you are no longer eligible to contribute to an HSA, you can't contribute to the HSA as of the first day of the first month after the month your high deductible health plan coverage ends. So, with healthcare being an important aspect of our lives and a large expense in retirement, we really can't ignore this HSA conversation. And we tend to see HSAs being dismissed due to a lack of understanding. And this confusion really arises because there's different types of health spending accounts out there that exist. So we're going to get into these different options. So you've probably seen some of them. There's many different types of healthcare accounts, leads to confusion. We're going to look at the most common. FSAs versus HSAs versus HRAs. So when it comes to flexible spending accounts, there's many different flexible spending accounts out there. There's FSAs to pay for dependent care expenses. This discussion is focused on healthcare FSAs. So a lot of people confuse FSAs and HSAs because FSAs have been around longer, but there's key differences starting with what that S stands for. An FSA is a flexible spending account, while an HSA is a health savings account. So a health reimbursement account called an HRA, it's true to its name because your employer funds the account. So you can reimburse yourself for certain medical expenses. The employer gets to deduct reimbursed employee medical expenses as a business expense. So the money you contribute and spend in an FSA, it's tax-free, but it's largely use it or lose it. So you're truly spending year to year. So because of that, it's important to the best of your ability not to contribute more than you'll spend in a year, or you'll end up losing that money. Money contributed to an HSA, on the other hand, that can be saved from year to year. So what we see is that many people are still treating it as a spending account because the funds roll over from year to year. You have the opportunity to save amounts for health expenses in future years, and you can invest the proceeds instead of holding them in a cash account. Also, in an HSA, you don't have to worry about leaving your employer because you own the funds. They move with you, which is not the case with the others. With HRAs, the employer can decide to allow the funds to roll over from year to year. They own the account, they set the rules for the employees. The health FSAs, they have lower contribution limits relative to HSAs. And also for FSAs, there's no requirement to be enrolled in a high deductible health plan, only that your employer offers one. In an HRA, only the employer can contribute. No employee contributions are allowed. And the employee's health plan does not have to be high deductible in that case. So for an FSA, the flexible spending account, you can't adjust your contributions at any time, only during open enrollment or when you have a change in employment or family status. I want to note one other difference, which is how these are treated when you leave your employer. So with that HSA, all funds, whether contributed by you or your employer, you are immediately vested. It will transfer with you even after you've left the job. With the FSA or HRA, you lose any unspent funds when you change employers. So if you're planning on changing jobs, you have some job insecurity, it's something to keep in mind. If you do end up having an HSA, you file Form 8889 with your Form 1040 at tax time if you've had any activity in the HSA in the year. That's contributions or distributions, even if the only contributions to your HSA came from your employer. So make sure to talk to your tax accountant about this. So we're going to talk about what is considered a qualified expense. So earlier we talked about getting tax benefits when funds are spent for qualified medical expenses. So we're going to discuss what qualified means. First, we're going to talk about who will be covered. So you can pay these qualified medical expenses for yourself, your spouse, unfortunately not a domestic partner, and any dependents claimed on your taxes. You can pay these expenses even if your spouse is not covered by an HSA qualified high deductible health plan. You can include your adult children in your family coverage until they're 26 years old, but can only pay their expenses from your HSA if they qualify as a dependent for tax purposes. That's under age 19 or under age 24 if they're in school full time. So now what do we mean by a qualified expense to get the tax-free disbursement? Only expenses incurred after you establish your HSA qualified. So qualified medical expenses would be the things that you would expect, any medical services like costs of equipment, supplies, diagnostics, treatment, prevention of disease. It also covers things you might not expect, such as premiums for long-term care insurance and long-term care expenses. COBRA premiums for people who might be retiring early and getting COBRA continuation from a former employer, or insurance premiums you may have to pay during a period of unemployment. As for Medicare expenses, you can pay your Part A. Most people don't have a cost for Part A. Part B, Part C, Medicare Advantage, and Part D, your drug plan premiums with HSA money. Since your Part B Medicare costs, they're deducted from your Social Security check in retirement, there is a reimbursement process that you have to go through. It also covers things that might not be covered under your health plan, like dental, vision expenses, hearing aids. This is important for people on Medicare since Medicare doesn't cover these costs. So now for what HSA money doesn't cover. So generally, you can't use your HSA to pay for standard medical insurance premiums. Or for your Medicare clients, you can't pay Medigap policy premiums. You also can't pay interest charges from a doctor with your HSA money, but pretty much everything else. So when in doubt, there's an IRS publication, 502 and 969. It will show a complete list of qualified expenses if you're questioning something. If you use money from your HSA for non-medical purposes prior to age 65, that amount gets added to your gross income, and there's also a 20% penalty on that amount. So now we're going to go into more detail on the specific benefits that come from owning an HSA. So HSAs, they provide triple tax benefits. You have pre-tax contributions, tax-free growth on the investment, and tax-free distributions when you use the money for qualified medical expenses. You have the flexibility to invest your HSA funds instead of just holding cash. Other retirement savings vehicles only offer one or two of these three tax advantages. So an HSA is really powerful. Furthermore, if you leave your employer, you still get to keep, grow, spend all of the money in the account, even if you lose your high deductible health plan coverage. All of the money in the HSA is yours, and that includes contributions from your employer, even if you leave your job or retire. So, in addition, anyone can contribute to an HSA on behalf of an eligible HSA holder. So even if you open an HSA mid-year, you can still contribute the entire annual maximum amount if you remain eligible for the entire next year. You have until tax filing deadline each year to make that prior year's contribution. So it's a great vehicle to help out at tax time if you have not maxed out your HSA contributions. And we spoke about how your HSA can be invested in order to get more account growth. A big appeal of this investment is you're not subject to required minimum distribution rules in the future, and you have all that flexibility to spend your funds as you would like on your own terms. If you decide you want to use the money for non-medical purposes after you've reached age 65, you can take a distribution and you won't be penalized, and you only have to pay taxes the same way you would pay taxes on your traditional IRA distributions. And for high net worth family, this gives another avenue to invest. You're not limited by your income. You can invest the maximum each year. So in tax advantaged accounts like your IRA, if you have a 401k or a 529 plan, you pay taxes now or later. With an HSA, the now or later can become never. These tax savings, they can compound to produce higher returns than those available from other accounts. So the HSA's triple tax benefit: pre-tax contributions, tax-free account growth, followed by tax-free distributions if used for qualified medical expenses. HSAs, they're never taxed at a federal income tax level when they're used for qualified medical expenses. It's always good to consult with a tax advisor about your state's specific rules in regard to HSA taxation, because California is unique where they don't give you as much benefits as some other states. But you can see on the left side of this slide that when you fund a Roth IRA or a Roth 401k, your contributions are taxable. With a traditional IRA or 401k, your contributions go in before tax to allow your earnings to grow tax-free on the higher contribution amount. But your withdrawals are taxable, and you're subject to required minimum distributions. As for 529 plans, the money you put in for education expenses, it has been taxed already. And of course, taxable accounts, they're just taxed across the board. So looking at the right-hand side of this slide to see how this plays out in a real scenario. Let's say you have 4 different accounts opened. They're going to earn the same amount of investment return. Let's say you're in the 24% income tax bracket. You have a 15% capital gains rate. Out of these 4 different types of investments, the HSA on a long-term after-tax basis, that ended with the highest dollar amount. This is because for the taxable investment account, as an investor, you get taxed on your dollar before you can invest it, and you had to pay taxes over those 20 years on the capital gains and dividends. With your traditional IRA, you got to put that dollar in without being taxed, and that allowed your money to grow over 20 years. But then you had to pay tax when you take the money out in retirement, which reduces the after-tax value. And now for the Roth IRA, you have that tax-free growth and withdrawals, but you had to pay tax on that dollar before you invested in the Roth. So that leaves us with the HSA being the most tax efficient option if it's used for qualified medical expenses. So just to, beat the dead horse and take this one step further. So unlike a 401k, the money you and your employer contribute to your health savings account via payroll deduction, it's not subject to Social Security and Medicare taxes. This is known as FICA. You look at your paycheck, you see OASDI. That's what you pay towards Social Security. That's 6.2%. You pay Medicare is 1.45%. And then there's an additional 0.9% Medicare surtax if you earn more than $200,000 as a single person, more than $250,000 as a married couple. So most states treat HSA contributions as tax deductible, but unfortunately, in the state of California and New Jersey, there's 2 states, your HSA contributions are not tax deductible. I'm sorry about that. And if your employer contributes to your HSA, you would pay California and New Jersey, if you lived there, state income tax on those contributions. So your payroll system handles that for you. If you're in one of those states, you're probably in California. But since your employer also pays that same 6.2 Social Security tax and 1.45 Medicare tax, they also can reduce the amount of FICA tax that they pay. So this tax value goes even farther than just the large federal tax deduction and tax deferred growth. So despite all the advantages we discussed, HSAs, they're not being utilized, with only 50% of people who own an HSA actually contributing to it at all. 14% are contributing the maximum amount that they can, and only 5% are investing in something other than cash. So there's a huge opportunity out there to get more of this tax-free growth. So now for the how, and the how really depends on how much you can afford to save. So if you have enough saving capacity, the best strategy is to treat the HSA as a long-term investment account by paying for current medical expenses out of pocket today. But if you have less capacity to save, the decision is more complex, and we have to look at both investment and behavioral, your health situation. So being smart with account prioritization can really maximize your overall picture. So Vanguard recommends start with getting your employer match if you have a match for a 401k at work, any HSA match. Don't ever throw away free money. Next, you should try to max out your contributions to an HSA if you're eligible and you have an HSA. So think about contributing up to the allowable maximum contribution, including catch-up contributions, if that's available to you. And then third, you look to your tax advantaged accounts like Roth or traditional IRAs, 529s, 401ks. And last, after maxing out all your other tax advantaged accounts, any other monies can be contributed to a taxable account. And what you'll notice is that we're prioritizing HSAs before any other retirement savings account. And why? We're just going to recap what we learned. For healthcare expenses, which most people will have their entire lives, they're triple tax exempt versus retirement accounts where you typically pay taxes either on contributions or distributions. So we're going to wrap up with some of these use cases. I'm going to talk about 3 different use cases for an HSA. So number 1, an emergency fund for medical expenses. Number 2, a retirement savings account. And number 3, a long-term care savings account. So we're going to talk about that emergency fund first. So the first and simplest way to use the HSA as an emergency fund is that the funds you don't use for medical expenses today can be used for medical expenses tomorrow. And since most people increase how much they spend on medical expenses as we age, and HSAs provide tax-free growth, it's a great way to save up for healthcare expenses later in life and through retirement. In fact, we encourage people to use their HSA funds as little as you can to take full advantage of the savings aspect of HSAs. So the second way to look at this emergency fund, this is somewhat more complex from a documentation standpoint, but it's called the shoebox strategy. This is when you don't immediately use HSA funds to pay for a qualified medical expense, but you use that expense later to get the tax-free withdrawal from the HSA. It's called shoebox because the idea is that you're storing your unreimbursed healthcare expenses in a shoebox to use later. And I do want to mention, to employ this strategy, IRS guidance is to keep records sufficient to show that the qualified medical expenses was not previously paid or reimbursed from another source. And it hasn't been taken as a deduction in any year. But this is sometimes a big ask over long time periods, but a lot of people do this. It's a strategy that gives you a lot of flexibility with your HSA savings. So it's helpful to be familiar with it. If you're new and you're just starting to contribute to an HSA, you only have $500 in the account, you get a medical bill for $1,000 that you pay out of pocket. You save that receipt and you get your $1,000 out of the HSA in years to come in the future after the money has grown. Let's say it's doubled to $2,000. You do not need to have the amount from your receipt in the HSA at the time of the expense. You just need to have opened the HSA and had any amount of money in it, just $1. I'm going to give you just one example of the shoebox strategy. So let's say you have money today to pay for your daughter's braces out of pocket. You save that $2,000 receipt for the future. So your $2,000 remains invested in the HSA. Many years later, it grows to $4,000. Now your daughter is in college. You need a little extra money to pay for college ancillary expenses. So you submit that $2,000 receipt for that qualified dental expense from years ago and take the money out tax-free from the HSA. And that account may have doubled in value since that expense. So set up your organizational system to save bills, proofs of payments. Many HSA holders choose to pay for medical expenses with their after-tax dollars, shoeboxing, filing eligible documentation until such a time they can bundle those expenses together for a tax-free reimbursement later in life. So moving on to case number 2, using your HSA as a retirement savings vehicle. I'm going to give you one last example from similar to this shoebox strategy, but it pertains to retirement. And we're going to refer to this as a time shift of your medical expenses. Let's say you want to delay Social Security until age 70 so you can maximize your benefit and get a bigger paycheck from Social Security, but you want to retire before 70. You can take evidence of those medical expenses you've paid over the years with all those documented receipts to pay yourself a tax-free salary, doing a lump sum reimbursement for that large amount of combined medical receipts to get you to age 70. And then you can turn on your optimized Social Security benefit check. And also, a lot of people will use an HSA to fund their Medicare costs in retirement because Medicare can be quite expensive. HSAs can be used for Medicare Part A, B, C, and D expenses. You do have to pay for your Medigap policy. As a taxable distribution, the government doesn't allow tax-free qualified expenses for Medigap plans, but all other costs can be covered as well from the HSA, dental, vision, hearing aids, things that Medicare doesn't typically cover. And as for that bonus benefit in retirement, as the account holder, you turn age 65, HSA funds can be used for non-qualified expenses without paying a penalty. You're just going to pay taxes on the distribution, similar to what you would do in a traditional IRA. So before age 65, if you use money from your HSA for non-medical purposes, and it wasn't a qualified expense, you will not only pay taxes on the distribution, but it comes with that 20% penalty. But age 65, use your HSA for anything you want. You want to buy a brand new Maserati, you can access the money without the 20% penalty. You just would have to pay the taxes as you would with a traditional IRA. And now for that last use case, HSAs are a great vehicle for saving for long-term care expenses. Long-term care is something we all need to think about. It's a risk that we should prepare for as we're living longer. Many of us, especially women, we need a few years of help where Medicare will not pay these expenses. HSA money can be used to pay for long-term care insurance premiums if you decide to get a policy to insure for this risk. So some people decide against a long-term care insurance policy as it can be costly and they choose to self-insure. An HSA makes a great savings vehicle for this because distributions to pay for the custodial care when you're elderly will be a tax-free distribution. Your money can stretch further. And this leads us to that last planning consideration. What happens to your HSA if you pass away? So when the account owner dies, any remaining HSA funds pass to the beneficiaries. If the HSA owner's surviving spouse is the beneficiary, the HSA becomes the HSA of the surviving spouse. But if your HSA passes to a person other than a spouse, the HSA ceases to be an HSA. The fair market value is taxable to the beneficiary as gross income. The value is determined on your date of death, and it can be reduced by payments made on behalf of the deceased person within 1 year of their death. Your estate can be listed as the beneficiary. So you think about it this way, the treatment is the exact same it would be for a traditional IRA. So to end here, we covered a lot of ground in our HSA crash course today. Key points to keep in mind around HSA are that these investment vehicles should be looked at as part of your broad financial plan due to their triple tax advantages and flexibility in retirement. So if you plan well, you're thoughtful over your working career, you can save a lot of tax dollars and potentially fully fund your healthcare costs in retirement. So if you have a high deductible health plan or you're shopping on the Affordable Care Act, make sure to check off and look at those HSA eligible plans. Don't miss a potential opportunity to save more for your future. So with that, I can answer any questions that anybody might have.
Yes, we just got one. Thank you, Julia. That was very enlightening. A lot of information to take home. And the triple benefit is really great and a lot of flexibility that might be available in the future. One question is, how long can you shoebox for? Is there a limitation?
They do not have a limit on that. So you can literally, the problem is we're all inherently a little bit disorganized. So I would suggest like electronically shoeboxing.
Right.
because
you need to keep the file, look at this file once a year to see if there is a way for us to use some of the expenses. Okay.
Yes, and yes, scan, save your receipts. But some people have done this pretty well.
Yeah, if I was a little bit devious, you could say that you can